Welcome back, tech enthusiasts and finance geeks. Today, we're putting the spotlight on Cisco Systems, the networking behemoth that's been a staple in the tech world for decades. Ready to decode the numbers? Let's jump right in. First up, let's talk price-to-earnings ratio, or PR. Currently, Cisco's PR trailing 12 months is at 12.26, which is a bit lower than its 5-year average of 14.67. What does this mean? Simply put, Cisco's stock is cheaper now relative to its earnings compared to the last 5 years. Bargain hunters, take note. Looking ahead, Cisco's forward PR stands at 13.54. This forward-looking metric suggests that investors are expecting slightly higher earnings in the future, but it's still in a reasonable range. Now, the PG ratio, price/earnings to growth. Cisco's PG is 3.06. A PG above 1 typically indicates the stock might be overvalued relative to its growth. So, Cisco isn't exactly a screaming buy based on growth expectations alone, but let's dig deeper. What about insider ownership? It's at a modest 0.23%. This tells us that insiders hold a small fraction of the company. It's neither a red flag nor a big vote of confidence, but it's something to keep in mind. Now, on to profitability. Cisco boasts a return on equity of 30.65% and a return on assets of 13.65%. These impressive numbers show that Cisco is efficiently generating profit from both its shareholders' equity and its total assets. And let's not forget return on invested capital at 29.3%. This metric shows how well Cisco turns invested capital into profits, another tick in the good news column. Continuing, with the earnings per share or EPS at $4, and over the next 5 years, analysts expect it to grow at an annual rate of 4.2%. Not explosive growth, but steady and reliable. Cisco's EPS has been on a positive trajectory over the last 9 years, with a compound annual growth rate of 7.65%. That's solid growth, folks. Free cash flow per share has also seen positive growth over the past decade, with a CAGR of 4.22%. More cash flow means more opportunities for reinvestment and dividends. Speaking of dividends, Cisco's dividend yield is currently 3.28%, with an impressive dividend growth rate of 8.41% over the last decade. For dividend seekers, this is gold. Cisco's operating margin is at 27.98%, and its profit margin is 23.49%. These margins are strong, indicating efficient management and a solid competitive position in the market. But here's a twist: the revenue and earnings have been pretty flat over the last 8 years. This stagnation has impacted Cisco's market price, leading to a lower total return compared to the VOO S&P 500 ETF. On the debt front, Cisco is doing well with a debt/EBITDA ratio of 0.46 and a debt/free cash flow ratio of 0.62. This indicates manageable debt levels relative to earnings and cash flow. Over the past 52 weeks, Cisco's average price return has been 4.39%. Not mind-blowing, but it's in positive territory. With a market cap of $201.12 billion, Cisco is a giant in the tech space. Finally, analysts are predicting that the stock price could hit $53.36 in the next 12 months, representing a 9.47% upside from its current price of $48.83. But here's my take. I believe the fair value of Cisco Systems is actually $63.27, suggesting it's potentially undervalued right now. There you have it, folks. Cisco Systems might not be the flashiest stock, but with solid financials, steady dividends, and potential undervaluation, it's definitely worth keeping an eye on. Smash that like button if you found this breakdown helpful, and subscribe for more deep dives into the stocks that matter. Until next time, keep investing smart and stay curious.